My lecture today is on the role of crisis management groups and how that relates to resolution planning. My name is Andrew Gracie. Until 2018, I was Executive Director in charge of resolution at the Bank of England. And I also chaired the cross-border crisis management group at the FSB. In the period from 2011 to 2018, I had a large hand in developing approaches and policy in relation to cross-border resolution for international banking groups. I want to share some of that experience and assess progress in that area with you in my talk. So an obvious place to start is, what was the motivation for the introduction of crisis management groups? One of the interesting features of the global policy framework was that while up until the global crisis, the financial system was increasingly interconnected and dominated by international financial groups, there was no parallel development internationally in mechanisms for managing failure in international groups. And this is ironic, given that the original impetus for discussion of international financial regulation was the failure, cross-border failure of Herstat Bank in 1974. Rather, all the investment pre-crisis was almost entirely in going concern regulation and supervision. And by extension, regionally and domestically, regulation and supervision focused on this too, as people implemented capital regulation downstream from Basel. And even then, in the design of Basel, the Basel Accords, it shied away from confronting home host issues. So Basel Accords, Basel I, II, and even III, are all designed to be applied on a consolidated basis. No discussion or settlement as to how capital generated under the Basel Accords should be distributed across jurisdictions in international banking groups. And also, until post-crisis, there was no formal agreed standard for liquidity regulation, in part because the central banks around the table at the Basel Committee jealously guarded their autonomy, having their own arrangements for access to central bank backstops, and so shied away from having an agreed international approach to liquidity regulation and how it should be applied in stress to international banking groups. And resolution is generally a lacuna in domestic regimes. So very often it's unclear which authority would be responsible for managing the failure of banks locally. And toolkits were generally lacking, especially for managing the failure of larger institutions. Domestic arrangements and Basel itself tended to be built around insolvency rather than giving public authorities formal tools to step in and deal with the failure of banks. That's not to say between the failure of Herstat and the financial crisis, there weren't failures, and there weren't failures that had repercussion internationally. But very often the efforts that led on from those failures tended to focus on information sharing in a crisis under memorandums of understanding, non-binding agreements, rather than confronting the need for more systematic tools, systematic approaches for managing failure. So, for example, after the failure of long-term capital management in 1998, there was, an effort in the Financial Stability Forum, the forerunner of the Financial Stability Board, to draw up templates of what information might be shared in the event of the failure of a large international banking group. And the consequence of this mismatch between the degree of cross-border banking and the systemic importance of cross-border banking and the policy frameworks for dealing with the failure of firms was that we saw massive bailouts in the global financial crisis, combined with massive financial instability. So we got double of a bad outcome. And the events of the global financial crisis were marked by repeated failures in cross-border coordination in dealing with these international banks, in international banking groups. That's globally with failures such as Lehman's, but also regionally in Europe with the failure of banks in Ireland, failure of banks in Belgium and the Netherlands. And so it was clear in addressing the problems exposed by the financial crisis that a solution, if there were to be international banking groups, a solution needed to be found for how coordination could be made to work, and coordination could be made to work on a time-consistent basis. So what has that post-crisis reform agenda involved in this space? Well, it introduced a new paradigm of resolution. That is that crisis revealed that insolvency doesn't work for large cross-border banks, for GSIBs, because it involves the interruption of critical functions, including cross-border. And so these banks need to be resolved so that those critical functions can be continued, and that can be done without the costs of doing that falling to taxpayers. But that new paradigm of resolution brought with it a concerted step up in cooperation arrangements. So an international standard was drawn up rather quickly by 2011 in the form of the key attributes for effective resolution regimes. And that leveled up across the FSB membership in terms of establishing resolution authorities and establishing resolution regimes that have common ingredients. And by putting in place this baseline for resolution arrangements across the FSB member countries and internationally, with that sort of level playing field, there was a foundation for cooperation, and there could be a degree of trust for host authorities in letting international banks into their systems, knowing that resolution arrangements were in place in home jurisdictions to this level of the international standards. But besides that international baseline around resolution arrangements, the key attributes also mandated the creation of crisis management groups, one per GSIB, that would meet regularly, annually at least, to discuss and draw up resolution plans for GSIBs. And these CMGs were envisaged not only as a mechanism for coordination in crisis, so that you had predefined the list of the key authorities that related to an international banking group and could bring them together in stress and in a crisis so that they could work together to manage the case. But crucially, CMGs were envisaged as a mechanism for ex-ante planning to remove barriers to resolvability. So a key part of this new paradigm is not only to equip authorities with the tools that they need to manage failure, but also that there should be detailed discussion and planning ex ante to ensure that those tools could be used effectively, and so that the use of the tools, the application of the regime, would be time consistent. And the key attributes envisaged that resolution planning effort being documented in resolution plans in the form of cooperation agreements, so that the members of the CMG would pre-commit in a cooperation agreement to the failure of a firm and the resolution of a firm happening in a particular way. So if that's the idea that was established in the key attributes in 2011, for the rest of the presentation, I want to talk about progress since then. And I want to start with the positives. So what is the good news around CMGs? CMGs are doing what they're supposed to do from a resolution planning perspective, in the sense that there has been progressive progress to address, face up to potential frictions around the failure of a GSIB and the cross-border coordination challenges that may be involved. So I've alluded earlier to how historically in Basel, distribution of buffers and financial resources in international banking groups was not something that was explicitly regulated for or addressed. in the context of CMGs, that's absolutely on the table for discussion and for agreement. And the challenge that's captured in the quotation attributed to Mervyn King during the financial crisis, that banks are international in life and national in death, that challenge is one that CMGs are grappling with. But an interesting phenomenon is that while the original conception of the key attributes is that there would be one CMG per GSIB with one resolution, one bespoke resolution plan per GSIB, in practice, resolution planning in CMG has brought with it convergence in thinking across authorities internationally about how GSIBs would be resolved in some form of top-down bail-in, whether that single point of entry or multiple point of entry. The general theme is that for GSIBs where you need continuity and critical functions, you need recapping the GSIBs to allow them to continue to be authorized for that continuity and critical functions to be achieved. That's likely to be done through top-down bail-in. And the resolution planning in CMGs has also brought with it convergence, resulting convergence in standards for resolvability. So as barriers to resolvability are removed, there's an agreement at an FSB level as what barrier removal involves, and then that can be applied across the GSIB population. So whether that's for total loss of building capacity, funding and resolution, operational continuity and resolution, bail-in execution, stays on financial contracts, whatever the topic, there's been a degree of convergence in how that resolution planning is carried out. And, going backwards. And then, crucially, that brings with it, the resolution planning in CMGs brings with it a greater understanding of interdependencies in these international banking groups cross-border. And with that comes, as more resolution planning is done, a recognition that cooperation becomes the route to get to a better outcome for home and hosts. So through the resolution planning in CMGs, there's an alignment of interests between home and host authorities, and the risk of a authority going it alone and taking their own route to resolve an entity locally. The recognition grows that it's more expensive and more problematic to try and go it alone than to go along with a cooperative resolution that's going to meet your interests. And with that is a growing recognition that separability through subsidiarization is quite often an illusion in terms of the autonomy or the scope to resolve locally without repercussions, given the business model independencies. So that legal form, whether the banking group operates internationally through branches or subsidiaries, is actually a secondary question relative to the nature of a bank's business model and the interdependencies in critical functions that gives rise to. So that's the good news. And the progress so far has been encouraging in terms of the discussion within CMGs around this. What are the challenges? There are numbers of challenges that still need to be addressed until finally one could be really confident that resolution will work on a cross-border basis. The first subtle challenge is that planning in CMGs is detailed and technical, and it tends to take place at a level below decision maker. So in building this apparatus for making resolution cross-border, how do you bind in senior decision makers? One device for doing that is running simulation exercises and war games, and authorities in some jurisdictions, notably UK, US, and European authorities have done war games together around GSIP failure. That can be a mechanism for getting commitments that are hammered out at a more junior level to stick at a senior level. Another challenge is that cooperation agreements transpire to be MOUs by another name. They typically only cover process type issues around how and when a CMG will meet and contact each other, and how CMGs will share information and the legal gateways for doing that. So the content of the resolution and how it will play out are generally not documented in cooperation agreements. And a question mark of where they get documented and how they get documented. I've alluded to distribution of financial resources on several occasions and talked about total loss absorbing capacity and internal total loss absorbing capacity, which is the mechanism for that distribution within banking groups. While that's been figured out for capital resources, the level of discussion around an agreement around liquidity is much less advanced. And that really matters because liquidity regulation under the LCR generates resources which are meant to be usable. And as such, it's not clear where, in terms of liquidity, point of non-viability, point of failure arises for firms. And while corresponding to capital, total loss absorbing capacity identifies a pool of resources that's usable by authorities in resolution, there's no such equivalent pool of resources for liquidity. And rather, the conception is that if the pool of resources generated in the LCR is used pre-resolution, then firms are likely to need public backstops to borrow from central banks or resolution funds. Clearly, where point of failure lies in terms of liquidity and what access there is to public backstops is a huge issue in a home host context. What level of LCR breach will any individual regulator decide that a firm is no longer viable? And how does that relate to the backstops that they'll provide? Are hosts expected to provide access to lending backstops, or is it for home authorities only? So there are significant coordination issues to be addressed there. Coordination needs to step up between supervisory colleges for going concern interactions and CMGs. Most of the heavy lifting about resolution planning has been done among the resolution authorities. Prudential authorities have been participants in CMGs, but the joining up between discussion of stress and coordination of stress and recovery situations in colleges and coordination of resolution in CMGs is underdeveloped. And there needs to be much more backward induction, in my view, from the sort of discussion around how resolution will work in CMGs in terms of how firms are supervised ex ante. One way of capturing that point is to raise the question, where would you see changes in approach to going concern supervision, discussion of going concern supervision in colleges that reflect the whole elaboration that's occurred since 2011 around multiple point of entry or single point of entry, for example? It's very hard to see the changes in going concern supervision that reflect the development of thinking around resolution. Another area where one needs to build out from the discussion in CMGs is in broadening the net across regulators. And I'm going to start with making this observation on a sectoral basis. Effectively, understandably, the resolution discussion started with resolution authorities and prudential authorities. It's now broadened in discussion of funding in resolution and liquidity backstops to involve the market operations, central bank lending parts of central banks. But there needs to be greater coordination with other regulators. Regulators for financial market infrastructures, where the rule books that FMIs operate under and are regulated do not explicitly support resolution. If the whole thrust of resolution is to achieve continuity in critical functions and access to reliable access in resolution to financial market infrastructure is central to that, FMIs retain far too much, in my view, flexibility in their rule books as to the actions that they can take against a firm going through a resolution process that might frustrate resolution. And similarly, the thinking in CMGs, the planning in CMGs need to broaden to include securities regulators. What's happening in a resolution is a bail-in of securities which will be subject to listing and other requirements from securities regulators. And GSIBs as listed entities will also be subject to disclosure requirements in the runway to failure, in stress, but also following resolution. And exactly how securities regulators will apply their rules to firms going through a resolution process has not yet been hammered out and remains a challenge. So that's the sectoral dimension of the coordination challenge that still remains in building out the resolution planning from CMGs. But there's a jurisdictional dimension as well. So CMG membership is limited to the jurisdictions with entities that are material to the group. So that's typically over 5% of group RWA's assets or revenues. But that means there's quite a long tail of other jurisdictions that may have a presence of the entity in their jurisdiction. And in quite a lot of these smaller jurisdictions, while the entity may not be material to the group, they may well be material within the jurisdiction, so relevant from a financial stability perspective in the jurisdiction. And the challenge of how to extend the planning that's done around resolution from CMG to non-CMG members so that you achieve time consistency in those jurisdictions too, and demonstrate that their financial stability interests will be protected, is work still to be done. And it's a challenge because going beyond the FSB membership and going beyond the jurisdictions which are home authorities for GSIBs, the degree to which there are full resolution regimes in place and the degree to which there are full resolvability standards, in particular TLAC requirements in place, it peters out. And so there's a degree in which until those host jurisdictions sort of catch up with some of those elements, that planning involving them, will always lag behind. And then the other coordination challenges around non-GSIBs. The decision was taken explicitly at the time that the key attributes were agreed that they would only establish CMGs and this resolution planning approach for GSIBs. But of course, there are numerous DSIBs that operate cross-border and operate are regional in the nature of their operations, and where some planning equivalent to CMGs is needed. And there's either a challenge in relation to those non-GSIBs that there are no mechanisms. So for example, the US operates CMGs only for its 8 GSIBs, but then it has firms that operate cross-border, which clearly have systemic functions. An example of that would be a global custodian bank like Northern Trust which has branches in UK and Europe and Asia, and is a niche bank, but is clearly systemically relevant cross-border. There is no equivalent of a CMG for Northern Trust. And then if you look in Asia, there are numerous regional banks, out of Singapore, like DBS, that, as it stands, there's a supervisory college, but there's no explicit equivalent of a CMG for those entities. In Europe, of course, BRRD established arrangements that mirrored the idea of CMGs, so that there are resolution colleges for European entities, and there are IRTs, resolution teams that undertake within a banking union context resolution planning for those entities, which they bring to resolution colleges. But there's a tendency for those regional arrangements, whether in Europe or in the US, to be very much framed in keeping with the domestic legislation. So in resolution colleges, the jurisdictions outside the EU and the banking union have a observer status, which clearly, having a two-tier approach to resolution planning like that doesn't necessarily breed confidence that it's an aim to achieve cooperation and coordination amongst equals. So these are the challenges. In part, they're the challenges because all of this is rather new. The key attributes only were finalized in 2011. They've all had to be legislated domestically. The TLAC term sheet, came in 2014. So there hasn't been a massive amount of time to work through a set of issues that have effectively been neglected for decades. So in conclusion to my lecture, what I want you to take away from this is that these efforts to do cross-border resolution planning in CMGs and in resolution colleges, wherever the venue, and from that resolution planning to ex ante remove barriers for resolution to work, is making, I would say, good progress, but significant challenges remain that need to be addressed. Thank you.